This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Before this week, the U.S. job market had been slowly cooling after a long stretch of resilience. Hiring was still happening, but at a more selective pace. Employers were posting fewer openings. Wage growth had started to level off, and layoffs were no longer just isolated headlines. Over the past few months, the labor market shifted from red-hot to cautiously stable, with companies focused more on efficiency than expansion. That set the stage for this week's data. Over the last several weeks, payroll growth steadily slowed compared to late last year. Job gains remained positive, but momentum weakened in technology, logistics, and parts of retail. Healthcare, government, and services continued to add workers, but not enough to fully offset softness elsewhere. At the same time, unemployment claims edged higher, suggesting more workers were quietly testing the safety net. The trend wasn't collapse. It was gradual pressure building under the surface. This week's labor data confirmed that slowdown. New hiring came in weaker than earlier in the winter, while layoff announcements picked up in select industries. Employers held on to core workers, but paused new expansion. The job market didn't break, but it clearly lost speed. Recent reports showed job openings continuing to decline, while weekly unemployment claims moved higher compared to January averages. Some large employers cited higher financing costs and softer consumer demand as reasons for restructuring. Policymakers reiterated that the labor market is still strong overall, but acknowledged that conditions are normalizing. The message was consistent: fewer excess jobs, less bargaining power, and tighter competition for openings. The real trend is moderation. The labor market is transitioning from worker-driven to employer-controlled. Hiring is becoming more targeted, wage increases are less automatic, and layoffs are more strategic than sudden. This isn't a crash, it's a recalibration after years of imbalance. This week fits into a broader pattern of cooling without collapse. Job growth is slowing just enough to ease inflation pressure, which policymakers have been watching closely. At the same time, layoffs remain uneven, concentrated in corporate and white-collar roles rather than across the entire economy. Overall, this is a mixed signal. Employment levels remain solid, but momentum is weakening. Workers still have jobs, but switching jobs is getting harder. Employers still hire, but only where demand is reliable. For households, this shift matters. Wage growth slowing means paychecks may rise more slowly this year. Job security feels stable for many, but finding a new job could take longer if you're searching. Severance packages and unemployment benefits become more important safety nets. Savings cushions matter more in a market where quick job hops aren't guaranteed. Think of how large tech CEOs have recently emphasized efficiency and cost discipline, not as individual decisions, but as signals of a broader corporate mindset shaping hiring nationwide. Next week, watch updated jobless claims, revisions to payroll data, and any signals from employers about spring hiring plans. Also pay attention to how labor data influences interest rate expectations, because job trends and borrowing costs are now